Well, hello and welcome back to Finspire's Focus on the Markets, third quarter 2022 edition. I'm Chris Karam, Chief Investment Officer with Finspire. And today we've turned to the kitchen table, the impact on home economics has on the future of what the rest of this year will look like, both economically and in the markets. So let's get to it. All right, we got to start out with our a little bit of an embarrassing photo. It was April 20th, 1980. This is an excerpt from the Ann Arbor News. I grew up in Ann Arbor, Michigan. Ann Arbor News were doing some profiles at the time of some families, some immigrant families, I believe. And I pulled this picture up because it's April 20th in 1980. Inflation was peaking in April of 1980 at 14.76%. Mortgage rates were hovering around 12.3%. Mortgage rates hadn't quite peaked yet. But unfortunately for my mother, my poor mother, she had to witness me attending the interview with the Ann Arbor News reporter in my Superman cape and shirt. As you can see, my brother and sister, my parents, very well dressed, and I think I was really stubborn that day and didn't want to wear what I was supposed to wear. But I got to tell you, I didn't have to have a lot of outfits because I really loved that Superman cape back in April of 1980. I was 4 years old, and all of that was happening around us. But nevertheless, thought I'd throw in some nostalgia, and also the fact that this was the last time when inflation and rates were really high. And there is going to be some perspective that I'm going to share throughout this presentation because it isn't 1980. It isn't April of 1980 in the markets or in the economy for that matter. It's not great by any stretch, but it isn't 1980. And we'll get more into that as we move along. So, worst first half of the year on record since 1970 in the equity markets. Not too many places to run and hide in various asset classes. And what you'll see here is 15 years of asset class returns, best performing to least performing year to year. The only place to be has been in commodities, and even at plus 18% is down from a quarter ago, from where it was a quarter ago. So you still see, due to the higher interest rates, you see in lower values, not just in equities, but also in fixed income. You see it in balanced portfolios, diversified portfolios. There was really no place to run or hide. The S&P 500 finished right at 20%, which is a critical bear market barrier. It actually went as low as 23.5% down for the year to date in the S&P 500, and small caps, riskier assets were off worse or more than the S&P 500 in the first half of the year. Now, because of that worst half, usually what we do see are big favorable results 6 months from now, 12 months from now. So now certainly not the time to throw in the towel, and I'll explain why. But first let's give some perspective to where these returns are today relative to where we were a couple years ago. And this is important because back in February, March of 2020, pre-COVID, or as COVID was forming and developing, and we were just learning about it, in the capital markets were getting infused with trillions and trillions of liquidity. That was coming from the Federal Reserve, both loosening monetary policy, loosening financial conditions. It was also coming from Congress, as Congress was injecting trillions of deficit spending into the economy to try to prevent us going into a complete economic collapse. Well, we had an extraordinarily bad second quarter GDP number in 2020, minus 37%. Really unprecedented at the time. Well, fast forward, we're now withdrawing a lot of that liquidity, and that liquidity in 2020 helped push markets higher in 2020, despite the fact that we had very significantly negative economic growth that year, and in through 2021, as that liquidity was not yet pulled from the marketplace or from the capital markets, and now it is. All that being said, if we look at where we were pre-COVID to where we are today, since the pre-COVID peak in February of 2020, the S&P 500 is up 11.8% since that point in time, cumulatively, point to point. And so clearly this recent sell-off is one of the most uncomfortable and painful sell-offs we had in a long time, since the January peak at the end of June 30th, down 21%. And markets sort of peaked right after the first of the year this year, before then collapsing down 21% or entering bear market territory. But I think that perspective is important, because really the issues that we're dealing with today are the inverse of the issues that helped us so much to get through 2020 and 2021. And now we're just having that liquidity withdrawn to the system. It's a very painful exercise. Now, it is not happening uniformly across all sectors. So one of the things that we've documented here throughout these videos and our slide decks is that energy has been a very good place to be, but there seems to be a rotation happening again in the equity markets. And the issue is this question about recession. So at one point in time, and these blue diamonds here show the peak return of each sector. And at one point, the energy sector was up over 60% on a year-to-date basis in 2022. Well, you can see that number has been halved to about 29% year-to-date, and for that sector's return. And you can see that other sectors, which haven't fared as well, naturally because of the rise in energy prices, are off from their troughs. Their trough returns, which are these X's throughout the chart. So we're starting to see a little bit of a tailing off of increase in energy prices, largely due to concerns about the economy, and that might favor other sectors down the road. So the big question is, the recession is in question. When will we know? Well, these things like economic growth and also like inflation, which we'll talk about later on, these are slow forming, right? And so we don't always get fresh data, in real time, so to speak. But we do get some trackers, some tracking mechanisms. So one of those tracking mechanisms is the Atlanta Fed. The Atlanta division of the Federal Reserve has something called the GDP Now tracker. And as data comes in, as new economic data comes in throughout the quarter, they post an updated estimate for quarter-end GDP growth. We know that the first quarter was off and a revised 1.6%. The second quarter, the Atlanta Fed is estimating a negative GDP growth of minus 2.1%, which in some textbooks would define a recession as 2 consecutive quarters of negative growth, which is what would happen if that number were to hold true. We won't know until July 28th. However, there's actually a division of the government called the NBER that actually determines whether or not we go into recession. It's all technical jargon. Nevertheless, we are in an economy that's receding or slowing. One of the two. We don't know yet. What we do know is that the leading economic indicators are deteriorating, still positive, but deteriorating. So they're weakening strongly, which is very consistent with all the data that has come in. But it's important from here on out to understand that the economy is not necessarily indicative of the markets. We saw that in big disconnect in 2020. The economy was not the market. People were really confused about how the market was doing so well as a whole in 2020 when we were going through so much turmoil with COVID. Well, similar things can happen in the second half of the year where maybe the economy worsens, but maybe the markets really start to behave more favorably for investors. So what are we going to experience? Are we going to experience, is it going to be a hard landing, a soft landing, or are we going to enter this period of stagflation? And that's a trickier one. So there are, I would say, probably the most likely scenario would be although the outcomes are wide and you have to prepare and manage the risks for a wide range of outcomes, probably the most likely scenario is there's some sort of soft landing, meaning that some sort of either by some chance we avoid a recession. I'm not sure about that, but maybe the recession is very shallow. And that's a popular train of thought because we've already perhaps reduced a lot of the excesses that are in our economy, whether it's in the inflations, whether it's in interest rates being adjusted higher, prices of stocks, of course, asset prices and bonds going lower. How much more can we go, right? So from here, what does this mean? Does this look like a soft landing where there's a shallow recession, especially with the labor market where it is? And we'll get to that in a moment. Or is this a hard landing? Is this going to be a very deep recession? And in order for that to come to fruition, you'd have to say, okay, corporate earnings are now going to be revised so substantially downward that they maybe corporate earnings start themselves go into recession as well, and we end up with a very hard landing, which would send our unemployment rate substantially higher, and there'd be more excesses, say, monetary policy, monetary tightening to be had in order to control inflation, which would take us into a much harder or a deep recession, a hard landing or a deep recession. And then do we enter this phase of stagflation? And this was the 70s parallel where you had this slow growth and high levels of inflation throughout about a majority of the 70s and the decade of the 70s. Are we entering that again? And some, although it's a minority opinion and it's maybe the least likely to occur because we do see inflationary pressure starting to ease. We saw that earlier this year. It could have been a head fake, although we're starting to see some further data that shows inflationary pressures are easing. Doesn't mean inflation's going away. In fact, doesn't mean elevated levels of inflation or uncomfortable levels of inflation are going away. It means that the inflationary pressures, however, are easing. And that's something that's been noticed over the last few months and is important because that's probably the least likely scenario. One of the reasons the least likely scenario is that the labor market's still very strong. Now, this could change, and we've started to see some softening in the labor market, but clearly they're starting to indicate that there's a little bit of economic weakness is starting to show up, but employment is a lagging indicator. So we may not see unemployment rate pick up from its very low level of 3.6%. We may not see wage growth, which is very high at 6.5%. Makes it very, very challenging as employers to control your bottom line naturally. And that's why you're going to hear from these publicly traded companies when their earnings season starts very soon and saying the impact that wage growth and inflation has not just on is having on their bottom line, and that could drive earnings revisions significantly lower. But unemployment rate at 3.6% is a very good and healthy sign. You would think that number is going to start rising, that unemployment is going to start rising, but it is a lagging indicator. And so in the meantime, that could really stave us from a significant inflation because typically if people are employed, they're still spending. Now, the problem with that is that people are in a lousy mood. The combination of inflation, gas prices being very high, mortgage rates now being high, so really crowding out those first-time home buyers that were looking for a home, say a year ago or 6 months ago, and now they're trying to find some supply inventories in the marketplace, but it's no longer affordable because interest rates have shot up to a point where they can't afford the mortgage payment. This puts people in a very sour mood. People are very discontented with the direction of the economy, of the markets clearly, and perhaps as the country in and of itself. You can see here consumer sentiment. This is a long-standing survey done by the University of Michigan. Is at the lowest levels it's been in 45 years, and it is a very difficult environment. The strange thing about this is that people are still employed, so working, still commanding wage growth, but they feel like they just can't keep up. And we'll get into the savings rate, et cetera, in a few moments. But people are really starting to eat away at the savings that they accumulate over the last couple of years, especially since COVID kicked into gear March of 2020. All right, earnings. Back to the kitchen table. Will there be leftovers tomorrow for dinner, or will we have we have to find a way to make another meal or two this week? This is one of those things when we're trying to have our kids stretch out meals. What are you having tonight, Mom and Dad? Well, we're having leftovers. And they're like, oh, great, leftovers. Well, we better hope there's some leftover earnings from the first quarter, which earnings reports were actually quite good, because we want some of those good vibes from a corporate earnings standpoint to really help boost trigger, if you will, a big rebound in the equity markets. In here, we've looked at this chart before, which is the S&P 500 earnings per share, which is in the Blue Mountain background. and the actual S&P 500 index in the jagged line that runs day to day. Well, this goes back 25 plus years, and naturally earnings drive long-term results in the equity market. That's not too surprising. Okay, that is how it works. But what we see here is, of course, prices have come down, yet earnings have continued to escalate. Now, what the equity market has been pricing in, especially due to higher interest rates and inflation, we're expected to see, I should say, earnings revisions go significantly lower. Now, just how low will they go as a whole? That is to be determined, and that will drive market results in the third quarter and in the fourth quarter, because what you could see are earnings revisions to come significantly lower in the third quarter, only for those companies to then surpass their revised lower expectations throughout the fourth quarter, and that's important. So I'll come back to the timing of the fourth quarter, which I think is interesting, and how we could finish the year quite strongly. That being said, because of the prices coming down, valuations are lower. That's a given, right? Based on the earnings generated, the big question mark, of course, is the earnings themselves. And we're going to find out a lot more here in the matter of a week or two or three when these earnings reports come in as to exactly what corporate America sees and what their vision is, looking forward into the health of the consumer. That being said, when you look at forward-looking 12-month price to earnings ratios, the U.S. large companies are right at or slightly below their 25-year historical average. It's a good thing. That means stocks are certainly significantly less expensive than they were to start the year. But other asset classes look also relatively appealing. So you look at U.S. small caps, which have a forward-looking price-to-earning ratio not quite at 16, but down here below 12. You look at, say, emerging markets, which have a below 12 multiple on their earnings valuation. So you can see Europe and the developing non-U.S. countries as well all look relatively attractive. Now, you might say they're attractive for a reason because they don't have as much potential future growth, or they're just getting into their financial tightening of conditions. Those are all valid arguments. That being said, things are less expensive. So the big question mark is on the earnings side. What are we going to get? Now, when we get a big recovery in the equity market, it is going to be because inflation and interest rates have stabilized. And those are still the two big things when you look at a macro perspective. Yes, earnings drive the long-term results of the equity markets, the fundamentals, but the macroeconomic indicators of inflation and rates is really where we are today. And unfortunately, inflation in particular is a slow-forming set series of data points. Typically, we get inflation data on a monthly basis. We'll talk more about the calendar of what those dates look like. But essentially, we are recovering from having too much sugar. And too much sugar meaning too much monetary stimulus that came into the marketplace, into the capital markets in the spring of 2020 during COVID, which spurred an enormous amount of demand. You couple that with too few ingredients, right? Meaning that we had supply issues. We had supply chain issues. And we still have supply chain issues related to COVID, especially in China, where they're locking down large cities with their zero COVID policies, which continues to interrupt supply chains. But then the last item here, things are simply too expensive to transport, and that's also a big driver of inflation. Gosh, if someone were to say, Chris, if you were to be king for a day, what would you do to help this inflation issue? It's letter C. It is do anything you can to drive more output and refine more of that output energy, that oil and gas that's coming out of the ground, to refine that into diesel fuel to get America moving again at lower prices. The diesel fuel costs are simply too high, and that is a big part that's driving inflation is the transportation costs. Now, I mentioned earlier that the big challenge here is that inflation is a slow-forming series of data points. Yes, we get these data points monthly. The high-frequency data that we get is sometimes helpful, sometimes indicative, or usually indicative, but the market tends to move less on some of those high frequency data points when it comes to inflation, and more so on the release numbers that come out at the end of every month. In particular, PCE, personal consumption expenditures, measure of inflation. We've documented on this program before how there are a lot of different ways to measure inflation. Core PCE has the Federal Reserve target of 2%. Right now it's 4.7%. You can see there's a little bit of a reduction here in the rate of increase of inflation. We also saw it in producer price inflation. This is the cost to manufacture goods and that we started to see roll over. We actually saw some interesting figures with the last CPI report, Consumer Price Index report, with durable goods inflation actually coming way down off its peak, well off its peak in the last report. Even though the market soured on that overall CPI number, there was some good information in that report that showed that inflationary pressures are easing. We want to see that to continue. We won't know again until the end of July, like some other metrics that we'll talk about here momentarily. Interest rates. When you get this spiraling effect of inflation, you think that something's going to cost more tomorrow, so you better go get it today. The same can be said about rising interest rates. Are you going to borrow money today knowing that it'll cost more to borrow that same amount of money tomorrow? And that's what's happening a little bit. We have seen, however, that so many millions of people already refinanced their homes or purchased their homes. The challenge today with interest rates, especially as it relates to mortgage payments, are those first-time home buyers. We'll talk about the flip side of interest rates here in a moment as well, because that's important. The yield curve looks a lot like our kitchen tables. It's flat. Okay, if you look now at 2-year yields, 10-year yields, they're virtually the same, with 30-year yields up a little bit from there. So eventually, as the Federal Reserve controls the short end of the curve and they keep nudging those interest rates higher, they're likely to do that again at their meeting in a couple weeks, likely by another 0.5% or 0.75%. We'll continue to see these short-term rates rise so that this line looks very, very flat, perhaps a month or two from now when we revisit what this yield curve looks like again. But very flat yield curve tells us that economic weakness is on the horizon. Again, not really newsworthy based on all the other information we shared, but important because how high these yields go, we could see next quarter or 2 quarters from now, we could actually see, instead of these yield curves continuously rising, we could actually see them fall again, depending on where we are in the economy and if we experience significant economic weakness. Now, here is the somewhat of the flip side of this, which is household debt service, which historical averages, we're still well below historical averages in terms of household debt service. Why? Because so many people took advantage of low interest rates to either purchase a vehicle or refinance a home or purchase a home. And as a result, debt service as a percentage of income is still well below where we are in historical averages, even though consumer debt is rising. And this gets into elements of the savings rate. Yes, people are spending more on goods because of inflation. That's eating away at savings. But there's a little bit of a cushion here. And that cushion could very well get us through the next couple of earnings seasons via the strength of the consumer spending. So when you hear the financial press say, is the consumer healthy? Is the consumer strong? Will consumer spending remain at a clip that is helpful to our economy? These numbers tell us that, yes, that is possible for that to continue, not forever, but for another few quarters until things stabilize. And that could be another one of those saving graces. Okay, the flip side of higher interest rates. This is really important. So this impacts especially those investors who are preparing for or are in retirement and generating retirement income from their investments. To put it simply, we are now above the average since 2009 in terms of yield that we can acquire from our investments, whether it be in high yield bonds, taking credit risk, or treasuries. being real safe with treasuries, very simply, the yield that we can experience and acquire and achieve from these investments can be very helpful in achieving retirement income. Now, why is that important? When you're trying to sustain an income stream with higher yields, you actually need less money to achieve that income stream than you do. You need less money today than you did when yields were lower. And this is an important aspect that, yes, asset prices are lower. Inflation is way too hot. But there is a flip side benefit of higher interest rates, and one that comes in the form of generating income on your investments is a little bit easier today than it is, significantly easier today than it was to start the year when rates were significantly lower. So there is a bit of a flip side to rates rising, and that is it. Okay. Politics. No better kitchen table issue than politics, right? Nothing gets you more in trouble than Thanksgivings, but politics itself is a kitchen table issue, right? Is my pocketbook, is our family pocketbook greater or smaller than when it was when the other guys and gals, when the current guys or gals were elected to office a year, 2 years ago, 4 years ago, 10 years ago, whenever it was? And one of the challenges that you're seeing now, politically speaking, which is that for the Democrats, they have essentially one-party rule over the White House, the House of Representatives, and the Senate. That historically has not been very healthy for markets. Markets really love that gridlock. Why? They love that gridlock when one house, the House of Representatives or the Senate, can neutralize the impact that the White House could have, for example, on influencing tax policy or spending policy in particular. So why is this important? This is important because if you get to a situation as of today, right, this is July 2022, midterm elections are in November, 4 months away. 4 months is an eternity in politics. But right now, clearly, the Democrats have a big challenge on hand on defending their seats in the House and the Senate. Of course, the president's not up for another couple of years. But what's interesting about this, if that holds true, if all the political prognosticators are correct, and that because of approval ratings being so low and the tide just being generally in favor in midterm elections to the opposition party, if all that holds true, and you end up with a Democrat White House and a Republican-controlled House and Senate, when you look at the numbers, it shows that that's actually the most favorable environment for equity market returns. Now, that's, again, something that to look out 4 months. 4 months, as I mentioned, is an eternity in politics. Anything could happen. But markets do tend to appreciate mixed, or a check and balance, if you will, across from the White House all throughout Congress. And we even see that with we particularly see that with in a Democrat and a White House, with a Republican-controlled House and Senate. And it could also be a split Congress, right? We see a split Congress where the House might be controlled by Republicans, the Senate by Democrats, with the White House being any form of mixture is going to be likely viewed favorably by the equity markets. And that's why you could see a combination of earnings revisions then being outpaced in the fourth quarter, coupled with a political change into a favorable equity market or to a check and balance arrangement that looks very favorable, that equity markets look very favorable on, all coming together at the same time. And if that were to happen, you could see a substantial run in the equity markets higher in the fourth quarter of the year. Okay, what else are we looking for? Politics is politics, but when we look at what's on the calendar here over the course of the month of July, things that we're looking for. So very shortly here, after this recording, is going to be the non-farm payroll report for the month of June, which will give us our updated employment figures. We're really looking forward to seeing, did the unemployment rate change? Is the labor force participation rate growing? These are all important indicators for determining what economic output will look like for not just in the second quarter, but third quarter and fourth quarter and beyond. consumer price index, producer price index figures come out in mid-July. The Federal Reserve is going to meet at the end of July. That will likely lead to a short-term interest rate increase of either 0.5% or 75 basis points, depending on the data that they see and assess at that time. So that's another important day that's going to move markets, as well as the GDP report. The GDP report for the second quarter 2022 will be first released on July 28th, and then we'll get the core PCE number, which is a key metric of inflation that the Federal Reserve looks so closely upon, and that's going to be released July 29th. And so those will be days that move markets. All right, capital market strategy board. So what do we do about it? Look, if you think we're going to go into as growth is slowing clearly, or if it's entering a recession, what do? You look for companies that can withstand. You look for companies and strategies that can withstand through their own cash flows, volatility in the economy, and an economic headwind. Also on the fixed income side, you want to balance credit risk with U.S. Treasury exposure. Why? We've seen interest rates actually come back down a little bit over the last week or two in anticipation of a weakening economy. So there are ways to balance risk, not just in the equity markets, but also in fixed income. Inflation. Inflation is still a big wild card. It's, as I mentioned, it's slow forming set of data points. It's important to maintain an allocation to real assets, but be aware of energy exposure. If we go into a significant recession, you're going to see energy prices come down because of the anticipated reduction in demand, in global demand, which could drive energy prices lower from here, perhaps counterintuitively, but could drive energy prices lower. And then don't forget that equities, especially equities, companies that offer dividends and have grown their dividends over time, oftentimes do a pretty good job managing inflation risk because those companies have a great ability to pass that inflation exposure or those increased prices on in the form of dividends. And so equities can be a big help managing inflation risk, and let's not forget about that. Interest rates. Accessing higher yields, as we discussed, can help with your retirement income plan. Or if you're just looking to generate income for whatever reason, these higher yields can be interesting to tiptoe in as you rebalance or take a look at rebalancing your portfolio. And then consider gradually adding duration to your fixed income position. And this plays right into those higher rates. And if we do get some weakness in the economy, it's actually could be a reasonable time to move into bonds and adding in duration in those bonds or adding in maturity and duration to help with weather an economic storm. The bottom line is be as diversified as you can because that range of outcomes is still quite wide and with various probabilities attached to them. And as a result, we got to be patient. This environment calls for patience more than other drawdowns. Why? Because we don't have a Federal Reserve that's going to bail us out with injecting a lot more liquidity in the system. They're actually in the position and posture of actually withdrawing liquidity. And so we have to be patient. Favorable returns usually follow a very poor first half of the year like we just encountered. So as a result, 6 months from now, 12 months from now, does that mean we're going to hit new all-time highs in short order? Not necessarily. On average, after a bear market, on average, the S&P 500 encounters new highs on average 792 days later. So there's some that clearly happened well before that, like we experienced in 2020. But there are others, and in 1991, there are others that take longer to form, and so that where we can reach new highs. Nevertheless, after very poor starts to the years, like this year, we do tend to get very favorable returns when we look ahead 6 months, 12 months, and 24 months after this drawdown. Can't thank you enough for hanging in there. I know this was a little bit longer than other sessions. We've got to make lemonade in the kitchens with the lemons that we're given. As always, please feel free to reach out to us. If you have any questions, if you want to email us to our general mailbox at yourtomorrow@finspireme.com, or you just want to visit us on the website for other content at finspireme.com, please do so. Thank you so much for joining us. I'm Chris Karam signing out for now, but we'll talk to you real soon.